Welcome back. Now, elevated coal prices in key markets and an increase in export saleable production from local operations have boosted Thungela's full-year performance. The South African thermal coal exporter said its local production grew for the first time in 3 years due to increased productivity and improved rail performance. This without adding additional capacity or material cost to the business. Thungela CEO July Ndlovu joins us now with greater detail on that performance. Thank you so much for your time, July. I do want to make just two key things, or rather dig into two key things that I've mentioned there in my intro. Let's start off with those coal prices, just making a distinction between where you experienced higher prices and where you experienced lower prices, but also just in general, the kind of commodity cycle that you are in.
So that's a good start. Firstly, demand continues to be quite strong. If you look at overall consumption for coal for 2024, again, another record year, over a billion tons in terms of the seaborne market. So demand is quite strong.
Okay.
Prices overall actually have softened compared to where they were in 23 and 24 and 2022. Remember, 22 and 23 are abnormal years. Prices were significantly elevated as a result of the war in Europe between Russia and Ukraine. Saying that, if you look at the long-term price that companies like Woodmark project, and that's certainly the line that we use.
Yeah.
The current prices that we're seeing are more or less what prices, the kind of prices that will be supported by long-term fundamentals.
All right.
So we think these are actually quite good prices. And therefore, as we report very strong prices, very strong results, this is on the back of what we think is satisfactory and good prices. And therefore, this has been really down to the one thing that we focus on, which is control the controllables, operate safely, drive productivity, and manage your costs. With that, you deliver good financial results.
Yeah. And would you say that this, the softer prices that we had from the abnormal years is really just short term, or that these kinds of prices then are supported by the longer term fundamentals, and this is where we can expect kind of to see a baseline going forward?
I would say we expect to see a baseline going forward. In the sense that if you look at the forward curve looking 18 to 24 months out, it is in contango. So prices are actually supposed to improve from where they are. We expect that to happen over the next quarter, maybe quarter and a half.
But not drastically.
Not drastically.
Yes.
But more or less to the ranges that we think are supportive. Our cost curve is actually quite a flat cost curve. So at current prices, there are some producers who are quite hurting. Okay. You reference the difference in prices. We sell coal to two different markets. The one is against the Newcastle price, predominantly into Japan, South Korea, and then for the rest of Asia, we sell against the API 4. Those two price references have always been different, with the Newcastle being higher, whereas the API 4 lower, which is the Richards Bay coal price. For that reason, we've always said Ensham is a margin play because it sells against a much higher price, whereas the South African mines are always about cost competitiveness. And that's why we're quite pleased with what we've been able to do, which is exceed guidance on cost in both geographies.
It's quite interesting that you talk about, the impact of the different kind of price landscapes. I did notice that your margins did soften, and I'm wondering then what impact or what play is it, considering revenue versus costs?
The way to read the margin contraction is price. Yes. On a year-by-year basis. But actually that has also been mitigated significantly by good cost control and productivity improvements. So those two counteract each other.
All right. Well, let's go into your production, July, because we did have green shoots in production, particularly here in South Africa. Growth in production for the first time in 3 years. You talk about improved kind of landscape at Transnet. How sustainable is that going forward?
When I spoke to you at interims, I said I expected Transnet to improve going into the second half of the year, last year, and 2025. And we've seen that improvement come through. And this is on the back of the work that we've been doing with Transnet on security, on signaling, on rail infrastructure. And what they've also done for us is bring additional locomotives into the corridor. And all those taken together is what has delivered the 8.4% increase year on year. But much more impressive is the improvement between H1 and H2, where they moved from 47.3 for the industry to 56, almost a 20% increase, when we think that is commendable.
Yeah. Well, let's go into Australia. You mentioned Ensham there. It also exceeded guidance in terms of production. In what stage of growth is the Ensham business in? And really, what's the fruit that you're targeting also with a 100% stake in the business?
So the 100% control of the business really just allows us to do what we need to do with the business to get its full potential.
Okay.
But remember that when we bought the Ensham and took operational control in September 2023, it was doing roughly 2.7 million tons. And we report that for 2024, it has delivered 4.1 million tons. An absolutely impressive improvement. That actually is testimony to the fact that this is a good acquisition for us. And it has played out exactly as we expected from an acquisition point of view. Does it have additional potential? Absolutely. But there is some water that needs to run under the bridge before we can unlock the brownfields opportunities at that mine. And we as a company will be communicating with the market as we unlock those brownfields opportunities.
All right. And actually just talking about that, I mean, we're looking at investment as well. And I'm wondering what your capital expenditure priorities are at this stage of the business cycle.
Our capital expenditure priorities are quite simple. Let's actually call them capital allocation priorities. Firstly, we want to complete the two critical life extension projects in South Africa, which is get elders to ramp up. Okay. That's important to us. And then complete the investment as the Zibulo North Shaft. Thereafter, we'll look at other opportunities that we've got in the portfolio. But you'd have noticed that this morning we said we're setting aside 400 million rand to prove the bankable feasibility study on our gas project. Okay. That's something that we're excited about. And as we make progress on that, we'll talk to the market. Over and above that, if we don't have any use for the money, we will return the funds to our shareholders.
All right. And as we did see an announcement there of a share buyback program. Thank you so much for your time and for your insights there, July. That was July Ndlovu, CEO of Thungela Resources.